Today is Tuesday, September 2nd, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, Mark Bowman, ADMIS Senior Market Research Analyst, and JP Snyder, ADMIS Associate Economist. And starting with the financials this morning, JP, what economic events will shape the markets this week?
This week is filled with economic data that will help shape a narrative as to how the U.S. economy is faring under the relatively set tariff picture. This morning, we got ISM manufacturing data for the month of August. That data showed that U.S. manufacturing PMI increased to 48.7 in August from a reading of 48 in July. That did fall short of market expectations of a reading of 49. Notably, too, the index signaled a sixth straight month of contraction as a sharp drop in production, with a reading of 47.8 versus the previous month's 51.4, was only partly offset by a rebound in new orders. Employment continued to fall, though at a slightly slower pace. We saw a reading of 43.8 versus the previous 43.4. The gauge for input price inflation eased to 63.7 from 64.8, but did remain well elevated overall. Survey respondents overwhelmingly pointed to tariffs as a drag on business conditions, citing higher costs, supply chain disruptions, and reduced competitiveness. Moving forward on Wednesday, we will see JOLTS job openings data for July, as well as the Fed's Beige Book, which is a summary of commentary on current economic conditions from all the different Fed districts. For the JOLTS data, that will be keenly watched for any signs of a pickup in layoff activity from firms. So far, firms have been relatively reluctant to lay off employees, as well as hire new ones, which has been reflected in recent jobs data, which has showed subdued job growth and a relatively stable new weekly jobless claims. Thursday, we get a slate of data: ADP private payrolls data for August, weekly initial jobless claims, non-farm productivity figures, trade balance figures, and ISM services PMI data, as well as S&P Global Services PMI data. This batch of data will be watched for signs of inflation in the services sector from survey respondents, as well as expectations for future growth from businesses. Now, to end the week, we get non-farm payrolls data for August, as well as average hourly earnings data and unemployment figures for Friday. Friday's data will be decisive in shaping interest rate expectations for the Fed's meeting later in September and beyond as well, as a softening labor market could add to expectations of continued easing from the Fed, which would make markets happy, although I am sure markets would be worried about the state of the labor market if the number is poor.
JP, regarding Friday's non-farm payroll report, what will traders be looking for?
Yeah, on the topic of Friday's labor data, I would pay close attention to the revisions of the previous month's jobs figures. Those have gained scrutiny recently over previous revisions, which reduced the number of jobs added to the economy by 258,000. Markets are increasingly expecting the Fed to cut rates at its September meeting, especially after July's week jobs data and revisions point at, despite an easing inflation picture, or a sticky inflation picture, which has pointed to inflation in the services sector remaining sticky as a result of tariff price pressures. Economists and officials at the Fed are undecided as to whether inflation from tariffs will be more one-off or a continual increase in prices, which has caused the Fed to adopt its notorious wait-and-see approach. But Powell's comments at Jackson Hole the other week opened the door for a rate cut this year, and markets are expecting that to come at the September meeting. Fed fund futures are pricing in roughly a 90% chance of a 25 basis point cut at the September meeting. But the importance of the labor market figures this week, after the latest PCE data last week, which saw PCE inflation come in line with expectations, did increase. So if job growth is seen as solid, I think expectations for the amount of easing from the Fed this year could be dampened. But if the data is poor and we see more downward revisions to previous jobs data, then I don't think it's out of the picture to expect a series of interest rate cuts from the Fed this year to help support the economy. So, in summary, pay attention to the revisions.
Thanks, JP. Mark, what will drive prices across the ag space this week?
Well, coming off the Labor Day holiday weekend, we're still almost 2 full weeks away from the next USDA report, which is on Friday the 12th. So over the course of the next week, we'll have a number of private production estimates for this year's corn and soybean crops. My sense is that corn guesses will be coming in below the USDA's very optimistic forecast here in August, where they projected production at 16.742 billion bushels with a record yield at 188.8 bushels an acre. My working yield estimate still a record high at 185.5, with production at around 16.45 billion. That's nearly 300 million below the USDA forecast. I'm also thinking that they're a little bit high on their beans as well due to some late season dryness across the southern Midwest and northern Delta region. My yield forecast is 53.2 bushels an acre. That would produce a crop of around 4.262 billion bushels, 30 million below the USDA forecast. I look for this week's crop ratings to show a 1 to 2% drop in both corn and soybeans. On the usage side of the equation, we'll get some key soybean and grain crush data after the close today. Look for a record amount of soybeans to be crushed in the month of July. The average guess is for 207 million bushels. And we're also going to have to continue to monitor developments on the trade front. The big news today being the Fed Court of Appeals decision on Friday that ruled that most of the Trump administration's use of tariffs are illegal. President Trump has vowed to appeal these the court rulings all the way to the Supreme Court, with the earliest action likely not to come before mid-October. For now, at least, the decision by the Court of Appeals does not favor the U.S. as trade negotiations with China continue to drag on. Still, no soybean purchases here from China. They're extending their coverage now on soybeans into November, all from South American origin.
And Mark, give our viewers a rundown on how the speculative traders are positioned in the ag space.
Yeah, the most recent CFTC report showed pretty aggressive buying across the ag space. Money managers were net buyers in this last report of 34,000 contracts of corn. Additional buying late last week beyond the reporting period. We think that short position now is down to about 85,000. That's the smallest short position since early part of May. Essentially, I think they're just questioning their ability to make money with prices below $4 a bushel. Speculators also been pretty good buyers of soybeans the past 3 weeks, flipping that position now back around to a net long 20,000. Looks like a good chunk of those are being sold today as the tariff headlines just generate a lot of whipsaw trading action. And money managers remain along a little bit of bean oil, while their record short position in soybean meal from 3 weeks ago has now trimmed by over half, still short 62,000. Still short across the market in all three classes of wheat, however, really not pushing the extremes like they were here this past spring.
Mark Bowman, last but certainly not least, 2 questions for you. First question, what's next for the sugar market?
So on Friday, the International Sugar Organization said that it expects the 25-26 supply deficit to narrow to just 231,000 tons. This compares to a deficit of 4.88 million last year, and they're crediting a 3.1% increase in global production. In addition, the Indian government announced this week that it has allowed production of ethanol from a wide variety of inputs, including sugarcane juice, syrup, and all types of molasses without any restrictions. Last year, they restricted volumes because of concerns over tight supply and fears of increasing domestic sugar prices. So this move seems like it's an indication of how confident India is about their cane crop this year after following 2 strong monsoon seasons. And finally, last week, Wkly released its estimate on Brazilian center-south sugar production for the first half of August, and it came in 16% higher than the same period last year. This is a significant improvement over July. And now cumulative production for the year is now running just 4.7% behind last year versus being as high as 7.8% behind at the end of July. So still we're running behind a year ago. This is the narrowest the deficit has been since the start of the marketing year in April. So it seems like signs are pointing up towards global production and global supply. And I think we could be back testing the lows this month.
And finally, Mark, do you think the bottom is in for the natural gas market?
Well, it seems it's possible. The weekly U.S. gas storage builds are starting to show slow relative to the average pace for this time of year. Last week's EIA report showed storage was 18 billion cubic feet up from the previous week versus a 5-year average of being up 40. And this was the third time in 4 weeks that the supply build was below the 5-year average. They had been running significantly higher than 5-year average all summer. Storage now down 3.5% below a year ago, still 4.7% above the 5-year average. So you add that, the Baker Hughes rig count this week showed a drop in rigs in operation of 3 to 119. This is still up from 95 a year ago and above the 5-year average of 109. But it's the first time it's been below 120 since mid-July. Now we're in the shoulder season when cooling demand drops off and heating demand is still slow. But there's not been a strong cooling demand all season, really, nothing to outpace the supply. But the long-term outlook is still positive. We have expanding potential for U.S. liquefied natural gas exports, and we also have this burgeoning data center demand that's going to draw more natural gas to make power. We also, I think that sellers could be reluctant to press the lows as we go into the winter heating demand season. So it's very possible a bottom is in.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.